Consider an investor with a sum of money. He can either look for a value stock with strong fundamentals and invest that money for the long term in a particular stock or equity. Conversely, the investor can follow momentum trading. He can buy the stock and then repeatedly buy and sell the stock in order to take advantage of trends or momentum in the market. However, this philosophy of trading, this very notion of finding patterns and trading based upon those patterns, violates the efficient market hypothesis and the theory of random walk, which states that past movement in stock prices are random, and those historical movements cannot be used to predict the future movement of a stock in the future. However, the proponents of momentum trading argue that the market is not perfectly efficient. Information asymmetry, flash crashes, volatility, and regime shift can lead to patterns which can be mined to generate alphas, they argue. Regardless, momentum trading has become popular. In fact, a search of Google for the term momentum trading generates about 73 million results. The objective of this presentation is to discuss a thesis that I wrote in partial fulfillment for the award of a Master of Science in Financial Engineering from WorldQuant University. My name is Oluwaseyi Awoga. So, what is momentum trading? Momentum traders generally seek to look for patterns in stock movement and leverage that to enter buy and sell positions. Typically, they use technical indicators such as simple moving average, Bollinger Band, and average true range to generate their trading signals. However, a stock that is moving in an upward trajectory can suddenly reverse and start to decline. Therefore, momentum traders must track volatility in the market. Otherwise, a previously positive position or profitable position can reverse course and start to move in a different trajectory and lose money. The overall objective of this exercise is to discuss momentum trading for both stocks and options, as well as discuss some of the methodologies that can be used to track regime shift, because the economic story is a cyclical one and it moves between period of expansion and depression or recession. Therefore, it is pertinent to track regime shift and affect our trading signals with the information generated. Before we start our extensive discussion, it is important to discuss the scope, data, and simplifying assumptions made in this research exercise. This research project covers stock prices, specifically Standard & Poor's Index, from January 1, 2007 to November 20th, 2018. The data used were downloaded from Yahoo Finance. And due to lack of free historical data for option prices, the Black-Scholes model was used to calculate option prices. We also assumed no transaction cost, fees, and slippages for all the strategies discussed in order to keep things simple. In addition, we assume that we have unlimited cash to enter buy and sell position. So So, what are the techniques that are available for tracking regime shift in the economy? Some of the methodologies available include using volatility ratio, the VIX index, a Markov switching type model known as hidden Markov model, but the list is not exhaustive. So what is volatility ratio? Volatility ratio is a technical indicator used for tracking the volatility of stocks, and it is usually used in combination with macroeconomic variables such as consumer price index, unemployment rate, interest rates to detect trading signals. Specifically, the volatility ratio of a stock is compared to a macroeconomic variable, and if the difference between the two is above a threshold, we enter a buy or sell signal. That threshold is determined using optimization techniques that iteratively search through some objective function in order to look for the threshold that maximizes a particular outcome. Another methodology for tracking regime shift or changes in volatility in the economy is the VIX index. And the VIX index is a calculation designed to produce a measure of constant 30-day expected volatility of the US stock market derived from real-time mid-quote prices of Standard & Poor's index call and put options. Finally, the HMM, hidden Markov model, is the thrust of our discussion for regime shift detection. And it usually works by analyzing a time series and identifying periods of low volatility and high volatility. That information can then be used in conjunction with a momentum trading technique to generate buy or sell signal. The VIX index. According to Rebecca Lehman, regime shift or market regime rather can be categorized into two categories. One is the risk on, the other is the risk off. A risk on regime is characterized by low volatility, low correlation between asset returns, high return to volatility ratio, etc. Risk off, on the other hand, is categorized by high volatility. The VIX index is inversely correlated with the market and it is mean reverting. So the technique is to go long when the VIX is too high and short equity when it's too low. As can be seen in the graph here, during the peak of the 2008-2009 financial crisis, the VIX index went very high as 80 and the stock market declined. As you can see, when the VIX index is high, the stock prices are very low. Therefore, this is a good time to buy. And then when it is very low, stock market prices are very high, which means it's a good time to short sell. As we can also see, it is mean reverting. It goes up and down, but always reverts back to the mean. So the VIX index alone does not tell us when to go long or short, but it can be used in conjunction with moving average technique or relative strength indicator in order to detect or determine trade signals. For example, a more than 10% difference between today's value and the 10-day moving average could be indicative of a significant change in the VIX index. In addition to that, the relative strength indicator, which can be calculated using these formulas, can be used to also determine extreme values. Values between 30 and 70 are generally considered normal. Another methodology that one can use to detect extreme values is the VIX futures curve, because when the curve is experiencing backwardation, the market expects volatility to revert, and therefore is a good time to buy because prices will eventually go up. The HMM is a Markov type switching model, and it works by going through a time series and generating signals. For example, in the chart on the slide, zero state indicates a low volatility period, while a state with the number 1 is the state with high volatility. So if the HMM signals a volatile regime, pass on long calls or stocks, and if it signals low volatility, pass on long put or short sales. The HMM is a very technical model, and in this presentation we have decided to focus less on the mathematical underpinning, but rather how we can use it to mitigate losses in our trading strategy. So to continue our discussion, we'll be discussing 4 trading strategies. 1 for stocks in order to keep things simple, and 3 for options. The first one that we'll be discussing is a simple moving average system for stocks trading. For options, we will consider a short call, short put trading strategy with or without HMM, at the money long strategy for straddles, and dynamically hedged and rebalanced ATM straddles. Typically, momentum traders try to buy when the stock prices are rising and sell when stock prices are falling. So we implement a simple moving average as follows. If the 10-day moving average price of the index is greater than 50-day moving average, our signal is to long 1 unit of the S&P index. Conversely, if the 10-day moving average is less than the 50-day moving average, our trading signal is to short 1 unit of the index. In addition, we use the HMM model, which we interface through an API, application programming interface in Python, to generate the level of volatility in the economy. If the HMM signals high volatility, we pass on trading even if our simple moving average signals a buy, and sell only if the HMM signals highly volatile regime. We then compare and contrast the key performance indicators for these 2 strategies, because the efficacy of a strategy can be measured by how better it is compared to an alternative strategy. Based on our implementation, the simple moving average strategy outperform a buy and hold strategy with a cumulative return of 73.2% for the SMA strategy and 52.3% for the buy and hold. A buy and hold is when you buy a stock for the long term and you do not trade it repeatedly throughout the life of the investment. However, when we implemented the simple moving average technique with the HMM signal and affect our signal, as discussed previously, we generated an even better return of 85.6%. Other key performance indicators are shown on the slides. As you can see from the graphs here, the blue line represents the performance of the 10-day moving average / 50-day moving average crossover strategy versus the buy and hold, which is shown in red. And in the chart above here, this is our trading signals. Of course, we could have extended it such that if the HMM signals a highly volatile regime, we exit our position totally instead of just holding off on buying or selling new ones. In addition, both returns for the buy and hold and the crossover strategy shows that they follow a normal return. As you can see on the chart, the mean is centered around 0 and it's equally skewed between the left and the right axis. For the option strategy, we decide our strategy as follows. The first one is the short call short put methodology. If the 10-day moving average is greater than the 50-day moving average, our strategy is to short one call on the S&P index. If the 10-day moving average, on the other hand, is less than the 50-day moving average, our strategy is to short one pull. First of all, we designed the strategy without using the HMM, and then we implemented another one that uses HMM to affect our trading signals. Calls are only sold if the HMM predicts a volatile regime, and puts are only sold if the HMM predicts a less volatile regime. As we did before, we compared and contrast the key performance indicators to a buy and hold strategy. So the payoff for both the short call and the short put are calculated as follows. In addition, we use this strategy or this formula to calculate the returns on our positions. It is important to note that it is better to agree on the methodology for calculating return from the outset. What we did here is just to simplify our implementation. So basically what we did is to deduct the payoff at the expiration of the derivative or option from the premium and divide by the payoff to get the return on that particular investment. But there are other strategies that you can use to calculate your return. From a conservative perspective, you can base your cost of investment on the capital at risk, which is the amount that you can potentially lose if the option moves against you. In addition, you may need to take into account margin calls, which may or may not be recoupable. One thing that we also need to mention that short selling options is not for everybody, and it requires a large amount of capital, because if things move against you, you can be required to make margin calls, which you may not be able to afford from a liquidity perspective. You can do a Google search for optionsellers.com to review a case about a company that just went under because it was selling options on behalf of clients, and the liquefied natural gas prices became so volatile, and the prices moved against the sellers, and they were required to make margin calls, and they could not. To implement the strategy, we divided our portfolio into two. So on the day that we buy that we sell a put. We don't sell a call automatically. And then we combine the strategy, the two strategies, the returns on the two strategies here to get our combined portfolio returns. And as you can see, our return is skewed to the right. In fact, we add 100% win ratio, which is almost impossible in real life. You have to understand that the option prices were calculated using the Black-Scholes, but in real life, option prices for American options are calculated using interest rate trees because they can be exercised before maturity. So as you can see, the buy and hold generated 5.3% annualized return, whereas the short call short put strategy generated a whopping 403,500%. And the performance of the short call short put methodology with the HMM was even higher with 427,000% annualized return. But you have to put things in context. This is not real life data. If we had used real life data, our outcome could have matched or been relatively close to real life outcomes. But because of data limitation, we calculated the prices of the options using the Black-Scholes model. Again, this shows that when you take volatility into consideration, your losses are likely to be less and you may make more profit. The third strategy that we implemented is the long straddle strategy. A straddle is a type of option where you either long both the call and the put leg, or you sell both the call and put leg, and it is usually a volatility play. A volatility in the sense that this option will only make money if you expect the price of the stock to move significantly in either direction. So as you can see in this chart, if the price of the stock falls or rises beyond these 2 points, you make money. Otherwise, you lose money. So in this area, you can lose money. In this area, you can make money. In this area, you can make money. Again, to implement the strategy, we did a simple straddle option, long straddle methodology, and we did one with low volatility and one with high volatility using the HMM to affect our signal. As you can see, that strategy made 48% return, the plain vanilla straddle. But when you sell in periods of low volatility, you make less money because, as I said before, straddle, like its cousin strangle, is a volatility play. So if there's no volatility, you lose money. When you play it in a period of high volatility, you make even a greater amount of money. To emphasize, we entered a long straddle position for 90 days, and then the next day, we calculated the amount that will be required to exit the position, and that forms the basis for calculating our return. Again, the returns, the distribution of the returns seem to follow a normal curve. Finally, the fourth strategy that we implemented is a dynamically hedged short straddle. So when you do, this is usually used by market makers. When you, for instance, if you have a long position and you want to limit your exposure to the market, you can sell options using any of the Greeks, whether delta, vega, theta, gamma, in order to make money and at the same time balance your exposure. So this, if you look at the chart here, this is our long position and this is our option position, such that at the end of the day, we have a net zero exposure to the market. So, for instance, to implement this strategy, we assume that you have position in S&P, long stock position. And then at the outset, you calculate the initial data to fully neutralize your exposure to the market, delta exposure. And we sell short option position based on that straddle position. So on a daily basis, we dynamically rebalance our straddle positions. We either buy or sell more going forward in order to make sure that our net exposure is neutralized. So your income is the premium that you receive plus or minus the movement in the stock prices. And then we compare to a buy and hold strategy. We did not affect our signals with the HMM signals because a straddle, dynamic hedging is a hedging strategy. It doesn't matter whether we're in a volatile or less volatile regime. We just want to neutralize our exposure to the market using a particular Greek. And when you use a particular Greek, you have made the decision that you're okay with movement that could occur from the other. So if you hedge delta dynamically, you are still exposed to changes in theta, vega, and other Greeks. So we calculated the key performance indicators and compared to a buy and hold approach. Our dynamically hedged straddle strategy outperformed the buy and hold approach, which buy and hold approach generated 5.1% and dynamically hedged straddle short straddle position generated 15.1% because we were selling selling straddle and collecting premium in addition to changes in our stock price. So the win rate for both are kind of like similar. In conclusion, this research project explores the relationship between momentum, stocks, and options trading strategies and the impact of regime shift on trading profitability. Based on our findings, losses are generally curtailed when trades are done in a less volatile regime, except in the case of straddles, which are only profitable in highly volatile regimes. Again, we made some simplifying assumptions. In addition, we calculated the options prices using the Black-Scholes model, whereas other methodology may be more appropriate. Using real-life data could have enhanced our research work and align our conclusions to real-life outcomes. Nonetheless, the system built in this research work can form the foundation for more robust systems in the future if these limitations are addressed. In order to ensure reproducibility, the underlying code for all the results are available in a Git repository and they will be made available to the public in the future. If you have any questions, please kindly email me and I'll be Glad to respond to you at my earliest convenience. Thank you.